Welcome to today's Explainer. We're putting on our sell-side equity analyst hats to unpack a really fascinating and honestly super contradictory financial story. We're looking at Laureate Education, trading under the ticker symbol LAUR. If you follow the education sector, you know that finding a company with both explosive market momentum and deeply conflicting fundamental valuation signals is, well, a pretty rare puzzle. Today, we're doing a rigorous dive into exactly what the fundamental models are telling us about this company's true intrinsic value. And trust me, the numbers we're about to look at tell two completely different stories. Let's get right into it.
Okay, so let's kick things off with this absolute monster of a number, 189.36%. That is Laureate's astonishing 3-year total stock return. In a market where consistency can be incredibly hard to find, pulling a return approaching 200% over a 36-month period, that highlights some seriously explosive market momentum. Investors have clearly been aggressively bidding up this stock, rewarding the company's recent operational pivots and earnings reports. And as you can see, this sustained upward trajectory, it isn't just a recent flash in the pan. Looking at the returns by period, we've got a trailing 12-month return of over 44%, which just builds on that massive 3-year figure. But check out the 5-year return. It is nearing an incredible 400%. I mean, if you had invested in Laureate half a decade ago, you'd be sitting on massive, market-crushing gains right now. Momentum investors look at a chart like this and see a company that just knows exactly how to drive shareholder value.
But here is where we hit our first section, the twist. Market price versus intrinsic value.
So, as any seasoned fundamental analyst will tell you, past performance doesn't always align with the underlying mathematical realities of a business. When we run the numbers and compare the current trading price, which is sitting at $32.81, to our calculated fair value based on rigorous discounted cash flow modeling, we see a really stark contrast. The DCF fair value calculation comes in at just $21.51, so the market is paying a massive premium of over $11 per share compared to what our base case fundamental models suggest.
To really grasp how severe this valuation gap actually is, we need to talk about the margin of safety. As a quick refresher, the margin of safety is essentially the buffer that protects us investors from estimation errors, market volatility, or unexpected operational hiccups. It's simply the difference between the modeled intrinsic value of a stock and its current market price. Normally, as a value investor, you want to buy a stock when the market price is well below the intrinsic value, right? Because that gives you a nice positive margin of safety.
Well, look at this. What's really striking here is this deeply negative margin of safety. At negative 52.52%, this means the stock is currently priced significantly, and I mean significantly, above its modeled intrinsic value. If our discounted cash flow models are on the money, buyers at today's prices are taking on a really substantial amount of risk. They're essentially betting that future growth is going to vastly outperform the company's historical cash flow trajectories.
Moving on to Section 2, Under the Hood, Profitability.
Okay, so why in the world is the market paying such a high premium? What exactly are buyers seeing that strict DCF models might be underweighting? Well, these impressive metrics right here represent the bull's main argument. Laureate is highly efficient at generating profits. Just look at the return on equity, sitting at a really robust 23.71%. And the return on invested capital, which you know is an incredibly important metric for gauging management's capital allocation skills, that is at 17.31%, which is actually up over 48% from its 3-year average. Plus, they're pulling down a net profit margin of nearly 17%. So the company isn't just growing revenue, it is highly effective at turning that top-line revenue into actual bottom-line profit.
Furthermore, their net income has grown at an absolute monster compound annual growth rate of over 59% over the last 3 years. When you have bottom-line earnings compounding at nearly 60% annually, yeah, that adds massive fuel to the market enthusiasm. This explosive earnings growth is exactly what momentum investors are pricing in. They're assuming this trajectory is going to continue into the future and eventually justify today's high stock price.
Now, let's look at relative valuation. Section 3, Valuation Multiples.
Let's see how the broader market is pricing these earnings by comparing current multiples to the company's own historical averages. And you know, the picture here is surprisingly mixed. The price-to-earnings ratio sits at 17.09, which is actually slightly below its historical 3-year average of 17.34. So based purely on recent earnings, the stock isn't historically expensive. However, if you look at the price to sales and EV to EBITDA multiples, those are stretched noticeably higher than their 3-year averages. For instance, the market is paying 2.7 times sales today, compared to just over 2 times sales historically.
And just to clarify, the enterprise value to EBITDA multiple gives us a much clearer picture of the firm's core operating value because it strips out the effects of different capital structures and tax rates. At 8.94, honestly, this ratio isn't astronomically high for a company growing its net income at 59% a year, and that adds a lot of nuance to our whole overvaluation mystery. Our absolute valuation, the DCF model, says the stock is wildly overvalued, but these relative operating multiples suggest it might just be priced for aggressive growth.
Which brings us to Section 4, the liquidity question.
As fundamental analysts, we always have to check the balance sheet to see if the company's financial health is actually robust enough to support this valuation without hitting any operational roadblocks. And the numbers here reveal a really fascinating juxtaposition. On the long-term side, they have extremely low leverage. A debt-to-equity ratio of just 0.11 is incredibly conservative. It basically means they are hardly reliant on borrowed money to fund their long-term operations at all. But look over at the short-term side. We see some concerningly tight short-term liquidity, with both the current and quick ratio sitting at just 0.67.
So why does this matter? Well, because the current ratio measures a company's ability to pay its short-term obligations using its short-term assets. A ratio under 1.0, and 0.67 is well under, indicates that Laureate's immediate liabilities currently exceed its easily liquidated short-term assets. In a vacuum, this tells us the company might face friction in covering its immediate bills, and that's definitely a potential red flag for a company valued at such a high premium.
However, before we go sounding the alarm on liquidity, we have to look at these cash flow mitigators. The company is generating strong trailing 12-month free cash flows of over $263 million. And that free cash flow, it's been growing at a 28% CAGR over 3 years, offering a really solid yield of 5.74%. This massive, consistent generation of actual cash significantly mitigates that short-term liquidity risk we just saw. Basically, they don't really need a huge stockpile of current assets because they are a pure cash-generating machine on a monthly basis.
All right, let's wrap this up in Section 5, the final verdict.
Bringing it all together, we really have to weigh these conflicting signals to understand Laureate's true financial standing. It's a classic valuation paradox. On one hand, the bull case is undeniable, right? Massive historical returns, excellent profitability, and almost zero long-term debt. But on the exact same token, the bear case is flashing some serious warning signs. A strictly modeled DCF fair value that's far below the current trading price, a deeply negative margin of safety, and weak current liquidity ratios.
Which leaves us with this final, really provocative question to ponder based on the data we've modeled today. Is Laureate simply riding an unsustainable wave of momentum destined to correct back to its fundamental fair value? Or does the market just know something the rigid, backward-looking cash flow models don't? When growth outpaces the math, it's ultimately up to you to decide which numbers to trust. Thank you so much for joining me for this explainer, and keep questioning the data.